Morning, Richard.
Morning, Sergio.
Good morning to everyone. Welcome today to another episode of Future Proof. I actually thought that it was such an interesting perspective what we covered last time with Richard that we decided together to do an episode two, a part two on the same topic. And we're gonna try to give it a little bit more of a structured narrative this morning because of the complexity of the subject and all the variable involved. So, Richard, thanks for coming again this morning.
Thanks
You
for having me.
well? All
Yeah, I
good?
am. I am. Thanks for having me.
So
I'm good.
yesterday we shared a couple of messages, no? And I think I laid down a sort of, I don't know, 3 points narrative that maybe we use to start the conversation this morning. On, diciamo, point number one, it was somehow understanding in general terms which are the market problematic somehow, which are driving the conversation towards a sort of African Union or Pan-African initiatives and collaborative initiative and aggregation initiative to actually go towards a future post-COVID, post-pandemic, where actually digital technologies are taking a very important role. So maybe I will start by giving you the opportunity to, I don't know if we can, I don't know, identify maybe three main problematics of friction, whatever we decide to define it,
Mhm.
just to keep the audience like quite focused on main points and give us a bit of discipline in the conversation.
Yeah, so I guess put it this way, I would also add, in addition to post-pandemic, post this idea of post-peak globalization. Right, so you've got a continent uh, with a very young population, um, lower income than other parts of the world, but with a history, as we talked about in the first one, of harnessing technology to leapfrog legacy infrastructure challenges. You know, mobile telephony being the main one. But one of the issues that remains is around the real economy, and from my perspective, the interaction between the real economy and capital markets and financial markets. And so one of the big issues is access to capital. Another issue is trust, transparency, and frictions that stop that access to capital for small, medium, and growing businesses. Industrialization is another issue, and capital financing that. Innovation, which again is something I know that you and I talk about a lot in terms of how that's financed going forward, to raise sort of, I guess, the aggregate distribution benefits to the population, and digital transformation. Playing a role in solving some of those issues, and either coming at it from, an institutional side, or coming at it from a technology side, or ideally both.
Yeah, which makes a lot of sense. And then I'm gonna let you continue. But somehow I'm reading a lot about a term which is deglobalization.
Mhm.
And deglobalization together with technology is telling me that somehow we are going back to a sort of smaller sovereignty because we are somehow inverting the trend because of a number of problematic that we are facing, but with the opportunity to leverage technology to create anyway a sort of trustworthy playing field under which you can carry the same global transaction that you used to carry before. That's, I think, is a very
Yeah,
interesting trends of the time that we're living in.
yeah, and so related to that is that where frontier and emerging markets um, are integrated into that, post whatever world, and remain active participants in it, or are able to participate more fully. And so I think that some of the ideas that you and I talk about are about how Africa as a continent and the nations within it are more a integrated, but are also collectively resilient, both economically, technologically, etc.
Yeah, it feels like that in the past, and then we go back to the to the topic. In the past, somehow I mean, the economic market was a sort of physical representation of the market itself, right? So the tendency was obviously to aggregate as much land, population, countries, whatever we're going to define it in terms of physicality. Why with the technologies, you start shifting this focus and say, actually, I could create environments which are digitally enabled,
Hmm.
which don't really are not really affected by the actual borders and physicality of a country itself. And that was somehow the physical principle under which I actually worked back in San Marino. So even though, I mean, I'm working for a small country, I mean, how big of an economy I can create and a big of an opportunity I can create by leveraging technology and creating sort of virtual market economies. No? And that's a conversation that is going on a lot in blockchain, where these platforms are basically run with their own monetary policies, with their own governance. The governance is released to the stakeholder part of the project. So I think that's the picture, the
Hmm.
end of the vision that we're trying to build. But sorry for the
No, no, no,
interruption. I mean, let's go back to the topic.
no, no. But I mean, I guess the in in discussing Africa and its digital future, whether just a digital economy. So there was a report out by Google and the IFC on the prospects of the internet economy, digital economy for Africa over the next 5 to 10 years, and they estimate that there is, an added $180 billion worth of opportunities that are developing in that space, and so as an ex-banker, ex-portfolio manager, principal investor, all I keep thinking about is how digital infrastructure might actually help lubricate and pump prime that activity. And so, how do we come up with the solutions and ideas you and I have been discussing are about how to address certainly the issue that has been problematic for financial integration for individual countries, but also the continent as a whole, is this idea around trust, or call it governance. And certainly from what I've seen, there's a view that is about the perspective that other parts of the world have about Africa, doing business in Africa, accessing opportunities in Africa. But then there is the equally big challenge of individual African countries trading amongst themselves as well, and adding complexity, adding value, as opposed to just focused on selling raw commodities at a price where again they become subject to external price shocks in a way that they cannot control.
But that makes a lot of sense. I think that the word trust, somehow, I don't know, we are rebuilding a lot of value proposition around this world by touching technologies, especially when you touch blockchain, certification, product origins. I mean, everywhere, no?
Mhm.
Origin of the funds, identity of people. It's all about creating systems which are bringing trust into the economy. And I swear it's the last time I'm going to interrupt you, but I'm going to send it to you, but I was actually listening to this TED talk from an economist named Jeremy Rifkin. I'm assuming that somehow you know him.
Mm.
And he was actually rebuilding the meaning of trust for the history of society. Now, if you go really back in time, somehow trust was identified in blood. So
Mhm.
the people that you could trust is your family. Then slowly society started to structure itself, and then it started becoming a sort of religion matter. So religion started to unify, like over the families, more families together. And then the trust started moving into sovereign state. So whoever does economy and transaction and relationship within a regulated state, parties can trust each other. And then slowly we created pan global sort of infrastructure to keep on building on this trust. And the provocation that it was bringing on the table is, by using digital technology, I mean, can we come up to an environment where we're not going to look, if you want, at unions like European Union or larger country, larger economy, but can we have a global, or if you want, a planet Earth sort of trust infrastructure that is gonna make us as a human being to look at the planet as our market and our environment. So even going over, if you want, the single country, single state perspective, and I thought it was a sort of very interesting perspective to look at in the future.
Yeah, very.
Anyway, let's
Yeah.
go back to the market problematics. Otherwise, we're gonna spend an hour doing philosophy on topics that we like.
But I guess I guess so. The again from our conversations, one of there are two developments that might address some of these problematics on the continent that you and I have discussed, and both are being led or have been developed by a Frexim Bank, the trade financing bank set up by the African Development Bank, 60 plus years ago. So Frexim Bank has developed the Pan-African payment and settlement system that would be a digital payment rail that will allow for the transactions between countries in Africa or between individuals in different countries, and allow them to use their local currency and settle invoices without having to trade through the vehicle currency of the dollar. The second is the Mansa data due diligence data repository that was launched yesterday. Although it's been onboarding people, companies, verifiers, etc., since May of this year, that seeks to be the gold standard for what could be trusted data from firms and institutions that will be accessible by subscription to across the continent. And I think that these two developments are both good, both needed, but I think that they can be built upon. And I think that I think the solutions that you and I are thinking about and talking about have the potential to be force amplifiers, but also be a means of collaboration for countries on the continent. So on the payment system, the next logical step in my mind is that once you eliminate those frictions of converting local currencies and allowing people to transact in their local currency, I then go to, does the continent actually need 54 or 55 currencies? Is the Pan-African payment and settlement system a vehicle that could help drive currency convergence? And then with Mansa, that platform has the ability to take cost out of the commercial due diligence and KYC process in a way that can be trusted. But I think the issue that we've discussed is about adoption and where the value proposition is that would drive adoption. What are the incentives that firms need to participate in it, and why?
So basically, if I can rephrase what you just said, we are saying that the major friction which are driving Pan-African initiatives are, number one, KYC. So you need to create trust in identifying and obviously facilitating the due diligence process to obviously facilitate business relationship and transaction.
Mm-hmm.
Then number two, it's settling somehow payments and transactions. Obviously, payments become the first and the easiest application of helping those economic counterparties to settle their economic relationship.
Mm-hmm.
And then number three will be governance.
Yeah.
Because obviously what you just mentioned about the currency or whatever is going to be verifying and certifying the validity of the KYC and those transactions needs a sort of Pan-African governance that is going to put everyone in a circle of trust to make sure that those information can be relied upon without incurring in further risk by using the technologies. Correct?
Yeah, exactly. And so put it this way: both of those call it platforms, have, as I say, adoption challenges, right? Because with Mansa, the level at the verification level, it will be commercial banks and central banks domiciled in the individual nations that will provide the verification for a business that does get Mansa verified, or begins the process to become Mansa verified. And as I when they at this launch event, when they showed the 8 steps that an individual firm needs to go through. I mean, as I say, it includes shareholder information. It includes which is a critical one, information on the ultimate beneficial owner, which is the thing that even when I was a banker at Barclays, in terms of anti-money laundering compliance, one of the things that you need to be sure of is who is the ultimate beneficial owner of a bank account that you open. So being able to collate and hold that information for a range of firms across a range of industries across all those countries allows individual financial institutions in those domestic markets to have more trust, and ideally not repeat that work, not have to repeat the work of another financial institution previously. But it does also allow for a way in which value can be extracted from that information existing in a format and at a level that can be trusted.
Yeah, so basically on KYC, what we're saying is the passportability of those information. Like nowadays, you are in a practical situation where every time you're dealing with a new counterparty, could be a bank, could be a company, normally you are asked, requested to reproduce a set of documentation which is used to evaluate whether you can be somehow trusted in the business relationship. While with this infrastructure, we are saying those information are created under the profile of a business or of a citizen who is working on his professional life independently. It's like that they are enriching the identity of the business or that individuals. So it's not about anymore the company number and the registration certificate, but you enrich those information with financials, with banking references, with another, sort of business important due diligence information, and this information are always available. So every time you walk into a new business table or in a new transaction, you can walk in with your information already verified. So
No,
somehow
exactly.
you don't waste time to re-verify all the paperwork and slowing down the process to create economic transaction. That's
No,
basically what we're trying to.
exactly. I mean, the idea is that every entity will have an Africa entity identifier number, which means that then you can go from institution to institution and give this number, and they can pull up and see a history of work, right, that has been done in terms of inputting into this repository that allows them to make decisions quicker. And for the better companies, it does mean that they're not having to reprove basic things again. And it allows for a better pricing of risk. So because ultimately I keep thinking and getting ahead to the idea of if these verifiers are central banks and domestic commercial banks, it should help reduce the frictions and that limit access to capital, but also ultimately reduce the price, because as we discussed last time, the amount of cost that goes into KYC for a bank, this will allow them to reduce their cost of capital, which will allow them to on lend to an entity, but with a better sense of the history of the entity itself.
Which somehow should be the right business model, because one of the arguments that you always read on newspapers everywhere is that the cost of the KYC has such an impact in creating a new business relationship that you end up the banks to cover the cost, they tend to pick the relationship they're going to get in.
Mhm.
So they prefer larger deals, obviously, to smaller deals. So the inequality that you get in the financial ecosystem is the small companies, small and medium enterprises tend to be in a certain way left alone
Yeah,
because they have to provide the same set of documentation. They have to somehow call for the bank to do the same effort to do the due diligence and clear, if you want, the transaction power, but then the fees and the profits out of that transaction is much smaller than larger corporation.
yeah,
So the
yeah,
system somehow should be bringing equality and financial inclusion back to small and medium enterprises, which is
yeah,
another, if you want, objective that we discuss quite a bit between me and you, and say how do we get there? How we can create a solution that is going to help, especially small and medium enterprises.
absolutely, absolutely. And I think that the that idea of democratizing the access to finance within individual regions allows for those regions to also retain market access to the broader international capital markets when necessary, because all the credit rating agencies will look at the institutional environment and the investment environment in individual countries when they rate sovereigns, which then affects the sovereign's cost of capital, which then affects with a sovereign ceiling the cost of capital for call it multinational companies from the region that need to access larger pools of capital and hard currency given the nature of some of their businesses. So being able to address and this underserved element of the real economy, which will differ in individual countries. So, the small and medium sized space in South Africa or Nigeria or Kenya will be different to Egypt, will be different to Tanzania, Uganda, Ghana, or Ivory Coast. But finding a way in which, I guess this is a solution, because Mansa is a Pan-African platform that allows comparability between countries for this information. So there is this real drive, or at least intention or intentionality behind the development of this, to address the problem on the entire continent, as it were.
So basically, what we said is that the friction, the most important or initial friction to be solved are KYC, trade finance settling, and obviously governance towards a Pan-African infrastructure,
Yeah.
right? So assuming that this friction are solved, what could be the opportunities that you can build a future economy? I think the one we just mentioned it. So is obviously the ability to rebring small and medium enterprises into a more effective financial ecosystem, which is going to support their growth, is going to support their trading, and is going to somehow bring innovation and new players into the economy. There's any other actors or stakeholder that are going to benefit from these steps, like stock exchanges or larger corporation?
Well, I think both larger corporations and stock exchanges or securities exchanges can benefit, because the pool of eligible companies, so they effectively, this will create a pathway whereby companies. So put it this way: if we say starting from at the smallest level of micro and small enterprises, this will allow for the formalization of businesses. As businesses are brought into the formal sector, for governments, it allows them to broaden their tax base, which also means that they then need to borrow less in local currency in domestic markets, and possibly less from the international capital markets. So it allows for a more efficient distribution of that pool of capital. Um, and as those companies develop, as they progress through the company life cycle, you can build national champions, and you can build regionally focused businesses, because the big goal of the African Continental Free Trade Agreement, the Pan-African Payment and Settlement System that was been built and developed to operationalize that, and Mansa, is that they're relative to Asia, for instance, the level of Africa intra-Africa trade is significantly lower than it is in other regions. So raising the level of that intra-Africa trade, and then allows you to, I guess, raise the level of complexity and value added for individual countries, which raises incomes, grows the size of the economic pie, and I think that is the main goal, is to make sure that there is more trade going on the continent between countries, which then makes the continent itself a more attractive investment destination for foreign investors from abroad.
So somehow, if you look at the equation on how to reach more trade going on between the countries, it can be either by an increase of trade volume from existing large corporation and players, or the other side will be enriching or increasing the number of players which are trading between themselves. So somehow small and medium enterprises come back into the picture, right? What's the opportunity to increase existing trade from large corporation already consolidated into the African market, and slash out to attract international investment into small and medium enterprises, which from here to the next 10 years are going to increase by 30% the economy transaction volume going on, correct?
Mm-hmm.
That would be somehow the two approaches. And whatever we discuss on KYC platform and technology, I'm still thinking that is gonna maybe help more the small and medium enterprises rather than the large corporations. Because in a sort of way, I think the large corporations are there in a consolidated system. They spend their money for KYC, banks are transacting. So somehow they are sitting into maybe not a super efficient working process and transaction process, but still they found an equilibrium and they can trade. Why you have an higher barrier to entry on the small guys. So do you have an idea on how big could be the growth in small and medium enterprises in case you have a more efficient financial market?
Well,
just out of your
no, but I mean it's a good question, because I've often joked to people that if you listen, again, pre-pandemic, you listen to any government talk about where they want to address gaps in economic development. It doesn't matter if it's a developed economy or not. There is always talk about the level of contribution of small and medium-sized enterprises to an economy, and the number is always somewhere between 75 and 85%, right? So if you just working backwards, if you think that in the case of Africa, there is a high proportion of the economy that is informal, so those are still small businesses, one-man bands, and so forth, that are not captured by the national statistics data, right? But Efrexim Bank figures that from a formalization perspective, that there's 5 billion a year on the continent that could be moved into the more formal economy as a result of helping reduce the frictions on payments, but also reducing some of those frictions related to KYC and due diligence, right? But I think it would be hard to sort of. I think I'll stick with just that. That's a pretty big prize in and of itself, that 5 billion. But I mean, if you sort of look at the level of intra-Africa trade being at 15%, whereas in Asia it is above 55, closer to 60. So just moving from just doubling from 15 to 30. It's a material additive benefit to the aggregate economic pie, right? And again, I sort of in my head already go to the next step of what then is the potential marketplace for securities or investments in Africa after these frictions are reduced? Is there a way in which um, you know more choice can be given to investors, and that being local investors, local institutional investors, and international, um, both retail and institutional investors, if the benefits of these initiatives are bedded in and people can see that there are opportunities that they can assess because they have more information. Um, it just seems like it is a pretty big prize. It's a big prize, and so I guess quantifying that is something that we need to think about.
No, but I think, I mean, we don't need a number. I mean, it was more about, is it big enough? Do we believe it's big enough to justify the effort to work towards it? And I think your numbers, I mean, your rationale just told me, yes, it is.
Yeah.
I think it's not worthwhile being left behind. It's not relevant, but I think
Mm-hmm.
is an important element to start including and understanding how to include.
Yeah.
And then actually, when you said I'm thinking about the next step, that's how my brain works as well. Somehow I'm a sort of traditional, romantic, idealistic guy, which is living a sort of progressive innovation world on a daily basis. So I've been following up whatever is going on in decentralized finance, blockchain, tokenization, digital assets, and I still go there as a sort of solution. So what really attract my intellectual power is the ability to design a sort of decentralized, frictionless solution, but with a sort of ecosystem governance.
Yeah.
Like, I don't believe we're gonna move towards complete anarchy and distribution on the management of money and insurance product. I still that's where the traditional romantic guy comes out.
Mm-hmm.
I mean, there is a reason why the Lloyd's of London has been creating an insurance market, and they started working on the rules to underwrite the risk before
Mm-hmm.
taking it on board. So you cannot expect that you can drop that inheritance from one day to another one, and then decide that people which are not domain expert for that specific risk can suddenly in a blockchain platform assign a value to the risk and transact and underwrite by themselves the sort of risk. So I'm somehow picking the benefits of automating those processes to make them more cost effective, more accessible, and maybe more trustworthy than they were
Mm-hmm.
before. Because the smaller the business, the higher the risk to really don't go deeper into the paperwork. And that's why I think some of this economic opportunity is left behind. So somehow
Mm-hmm.
that's where I'm going. So I'm thinking once you build a sort of KYC, a Pan African KYC infrastructure, so
Mm-hmm.
you know that you can whitelist players and stakeholders coming into the ecosystem to transact.
Mm-hmm.
It's a little bit like crossing the border in a country. I'm free to travel around, get into a restaurant, buy my food, go in a hotel, visit the museum, and maybe sit down and do business with someone. I'm cleared.
Mm-hmm.
No, so that's a sort of important
Yeah.
visualization.
Yeah.
I'm clear, then I can enter the platform. So the
Yeah.
platform starts by allowing me to settle my trade finance in a more effective way. So large and small corporation, that's the
Yeah.
first benefit. So
Yeah.
the first benefit should somehow create the adoption and increase the volume on transaction of the platform.
Yeah.
But then at this stage, you can start adding another number of functionality. I mean, you can get to a point, correct me if I'm wrong, you can get to a point that you can also tokenize investments. The small and medium enterprise will need to build a business. And that will get closer to a traditional capital markets environment. How do you
Yeah.
see that
Yeah.
happening?
No, absolutely. I mean, I so that is exactly where the potential for this lies, is because um, small and medium-sized businesses need access to capital. And the thing that stops them from getting this capital is knowing how to access it in some ways, or the willingness of the providers of capital to lend to them, to invest in them. And so the I think that the big driver is that there can be a more transparent market, as it were. So as you using your metaphor, that once you've sort of cleared that minimum hurdle, you can be seen, as it were, as opposed to individual economies knowing that there are people transacting because they are, but doing it in the shadows in one way or another. So I think that
By
there's a
themselves, I always
yeah,
say,
yeah,
solving problems by themselves.
yeah. So the there is this potential for um, being able to aggregate and see and trust that there are X number of companies that we can do a minimum, or have breached that minimum KYC hurdle, so we can then start thinking more about the businesses that they are involved in and the opportunities that they are seeing, as opposed to whether or not what I guess doing that spending a lot more time on the due diligence around the basics allows I guess for a higher order conversation to go on between capital providers and capital seekers, and then you need to be able to provide liquidity and a secondary market that will allow, if not a market to set a price, you can discover prices. That I guess that's the beauty of any of these crowdfunding platforms that exist on the continent, in Latin America, and certainly in Europe and North America. They still lack a degree of price discovery. It's about private companies in a closed ecosystem looking for investors and matching with them. And I see a lot of these matching services where companies again meet a hurdle. They're inside this sort of closed ecosystem. There are then other investors that also come in, and they're looking for things, and then there's a normal sort of tug of war between those two institutions on what is the right price for investment. If you create more competition between companies because you've got a bigger pool that have all sort of gone over that minimum hurdle, it allows for, I guess this gets to sort of the velocity of money, and that there'll be more money available and more opportunities and more competition, and effectively you start growing the pie.
Yeah, which I'm thinking that one of the main goal is actually to create liquidity in
Mm,
this sort of transaction, right? Because I agree, but the price generally, from an economic perspective, is defined by the market. So if you don't have an effective and efficient market based on liquidity, I'm assuming that you have those price discrepancy. So I'm one of those guys that never really understood crowdfunding, or at least
mm,
I understand very well the social value proposition, and I get it. So the translation is the people are willing to invest in risky businesses and are getting closer and closer to startups as a sort of asset within an investment portfolio.
mhm,
They are not saying that is too far away from my goal. I want to keep on buying bonds. And that's a very important signal from the market. But at the same time, it's a sort of crazy way to spend your money, because one of the major problems is, apart from the rate of failure that you have with medium enterprises, but I mean, that one is absorbed into the price. But then when am I going to get my money back? Like, how long is it going to take? So it's not really an investment with a time horizon. In an investment with basically zero time horizon. So if you go back and you have a look at the number of tech companies or small and medium enterprises being listed, it's very small.
mhm,
So I think, I mean, in Europe a few years ago, I remember a 3% of new startups to stay within the innovation ecosystem reach the Series A. And the
mhm,
Series A means that you basically have a product validation, market fit, and you can start growing at scale,
mhm.
which means that 97% of those businesses collapse,
Yeah.
die at some point. So Do they die because they're not able to manage the business? Do they die because they're not able to create liquidity and to have an effective capital deployment in the ecosystem of playing with? I don't know. We should do a deeper research and have a look at the transaction. But certainly for me, liquidity is a big issue. So what I'm thinking is that technology can bring the same liquidity that
Mhm.
you have in traditional capital markets into another economic ecosystem,
Yeah.
leveraging technologies, whitelisting, automation, and be sure that you can improve the capital deployment and capital flow within the economy. Am I
Yeah.
right?
Yeah, no, you're absolutely right. You're absolutely right. Because I think underpinning that that path, right, is this the change in the underlying composition of individual economies, right? So where in Africa or other developing markets there had been a, there is a sequence, right, where if you take people moving from rural to urban centers, it changes the dynamic on how much or what proportion of the economy is involved in sort of sustenance agriculture, right? And so as people move to the cities, they need to be doing different jobs. They're certainly not farming in they're not farming in cities of of millions, right? So they are developing businesses that might be service based. They're developing businesses that might be about light manufacturing and other parts of the value chain for whether the extractive industry, apparel industry, or what have you. And so the businesses that are being started, there are some that really what they need is access to they need to be lent to at a rate that they can afford and continue to grow their business. And so the payoff for a loan is I can model that in a different way with a different time with a definite time horizon. But people, and that when I say people in this case, I mean people who want to invest in these businesses and have an economic stake in that business, they do need to have a longer time horizon. All DCF models are basically forecasting cash flows out into the almost out into infinity, and a lot of the value is derived from a terminal value that is just a model, as it were. So there is I guess there is a cultural element around investing in equity. And I don't even mean investing in tech companies where, as you say, there might even be a much higher rate of failure, but investing in a business for the long term. Um, as an investor, you want to know that you've got liquidity to exit that investment that is not aligned with the time horizon of the founder, because this founder is sort of building a business that is supposed to exist in perpetuity. So liquidity helps manage that those differing time horizons.
But it makes a lot of sense.
Mm.
But what do you think? Now, I would like to go back a second to the governance.
Mhm.
How much governance innovation do you think would require such a vision in terms of creating a Pan-African infrastructure? Like the question would be thinking about Pan-African trade.
Mhm.
I don't know how regulation are evolving, but I'm thinking that like in Europe, you have certification on product and services, origin, and this regulation that might change country by country depending on what happened in the past years. So would it be a tremendous exercise? Do you think somehow flattening down those regulation, those verification, certification to make sure that you also have from a sort of service and product perspective a leveled environment, or do you think would require a hell of a long time?
Well, I guess this is, again, this is the goal and objective of the Continental Free Trade Agreement, is to sort of reduce those non-tariff barriers between countries, because that's actually what is the biggest constraint on intra-Africa trade is the differences in regulations between countries. Now, a lot of those regulations might have been developed and passed locally for very economically rational reasons. It's this idea of sort of beggar thy neighbor, it's a mercantilist sort of approach to doing business, as it were, where there's an element of harmonization that has been agreed at a top level, that are, from a principles basis, or with the agreement of the free trade agreement. And so the opportunity is probably in codifying what is agreed at the top level in a way that doesn't require, it doesn't require a sort of a second sort of approval at the domestic level. Does that make sense? That if you can basically hard code as soon as something is agreed at the top level, so you just take the legislation that has been ratified by all the governments that are going to participate in the launch of the Continental Free Trade Agreement on January 1, and you allow the technology to be the governance provider. That's where it's done, and that way, even if national governments are slow, business and transactions can still happen in a way that they all have agreed. Does that make sense?
Yeah, it does. I was actually thinking at what is the sort of score that you get on country? Easy of doing business? No,
Yeah. So
easy.
well, there's an ease of doing business score. So that's the World Bank that puts it together. And remember, I think we've talked about the fact that a number of the things that it looks at are how long does it take to set up a business, what are the nature of some of these constraints and barriers to setting up a business, providing information, which again is going to be being addressed in on one way by Mansa, right?
Yeah, but exactly. But the interim perspective was that if you apply the same rationale and you include it into a platform like Mansa, you could assume that the intermediary can somehow score transparency,
Yeah.
origin, certification, production. So, I mean, it can somehow move and become the sort of driver for domestic environments to upgrade, innovate, improve those regulations to make sure that they can do as more business as possible in the new technological environment. So you could actually get up and running with the system without having the need
Yeah.
to adapt the whole local regulation before you get started.
No, exactly.
That's what I developed. That's the picture I developed in my mind where you were explaining.
No, exactly. And so this is where I go back to the adoption problem, right? Because in order, there's got to be a tipping point, right? Whether it's at a national level, or at a continental level, that if there are, let's just say, if there are 1 million businesses in a country, right? If you've got 500,000 of them as Mansa verified, it's much easier for let's say I'm at a rating agency to understand that, well, half of the companies in this country have gone through this process. I can actually then look forward and say that, regardless of how many of them fail, that there are a number of principles that effectively have been adopted, by a critical mass of companies there, and I will then have a view that the environment and the likelihood of how easy it is to do business in that country should be easier than a country where they also have 1 million businesses but only have 50,000 that have become Mansa verified, because we will know what the as you say, what those principles are that are embedded into that platform, and so we can then take a view on how not necessarily how likely those companies are to succeed, but how much we can trust the pool of information on companies in country X, as it were.
Yeah, exactly. And then create a sort of independent criteria like the one that we are used to deal with on a daily basis. Today you have credit rating, product certification. I have tons of these sort of criteria under which you can compare and take decision on the product, service, or companies that you're going to engage with.
Yeah.
So now you build digitally the same infrastructure or criteria, you make them available to the counterparty that want to transact,
Yeah.
and those counterparties are going to take their own decision on where to risk. Do I prefer to risk on product certification? Do I prefer to risk on finance solvency, or whatever is going to be the solution, because the perfection doesn't exist.
Mm.
But that creates a sort of very level playing field of data infrastructure, analysis, and clearance of the counterparty, that
Yeah.
if you attach the liquidity, somehow you have a perfect digital environment to
Yeah.
facilitate and enable and develop trade.
Yeah. And I think that strangely enough, it will also allow you, or allow market participants to more effectively segment markets, right? Because you are then able to see, well, these are small businesses that what they need, or the services they need, are very different to, medium-sized businesses, especially medium-sized businesses that even if they've got longer tenure, but might have, more interesting businesses, in the sense that, there are more scale opportunities, that their product reach can address different issues across borders more easily, that allows for a different set of products, financial products, to be targeted at them. And I think that the idea is that, again, going a next step is that, that we keep mentioning sort of a minimum hurdle with Mensa, right? There needs to be a way of call it a Mensa plus, right? Or that something that maybe this platform actually sucks all that information out of there, and then can add another layer on top of it, in terms of what type of capital that they're looking for. So whether they're looking for, longer term borrowing, whether they're looking for more flexible borrowing, or whether they are looking for risk and growth capital, in a way that will allow them to I guess, either drive innovation, but also increase wealth, as it were, because wealth creation. Certainly, I live in London, and if as you used to, that you know the amount of wealth that's been created by having bought a house or a flat in the right part of town, 15 or 20 years ago. It's not necessarily a productive wealth creation process, but it is a wealth creation process, and that ultimately is something else that in terms of raising countries on their development path from low income to middle income status. That is the bigger challenge, on a sustainable basis.
It makes a lot of sense, because once you have, I mean, we always say, we do research, and you know it better than me. I mean, if you have a good sets of data, then you can build on top of it whatever analysis and research that you like.
Mm-hmm.
So the interesting aspect is that if you have a very well structured and architectured database and clear system, then all the banks can also create some other business model. I mean, the research, the trade research, the investment research can actually reach a much deeper level into the economical sector that is trying to look to deploy money. The service can be monetized as much as they can be monetized the money management and capital deployment, which is, I mean, one of the biggest businesses of investment bank of funds, which are managing institutional money and directing and suggesting somehow investments.
Yep.
Everything depends on the data. So either those data are coming from individual database or external sources, but I mean, that's why Bloomberg somehow existed. That's why you have these intermediaries. So you're also going into that direction. You create a very important set of information which are going to allow you to understand the economic environment, help you to grow, and at the same time create business opportunity for the existing players.
Yeah. Yeah. Yeah.
Makes a
No,
lot
and
of
I
sense.
yeah, and I think that's again, this is where we both agree that there is this potential. Um, and I think that the key for me is that again, having listened to the sort of there's a long range view, right? But I think that there is a way of accelerating the process, or the process to a point at which some of these benefits can be derived quicker, right? And I think that in order to do that, my view is that there is another institution that needs to, if not exist as a layer above these sort of initiatives, but effectively harness them in a way, in a targeted and focused way, to help accelerate that process.
I agree. A sort of development agency,
Yeah, and
business
and
development agency, investment agency, the sort of player which is typical of government architecture, that is just dedicated to leverage certain assets and
yeah.
keep on extending the business around it.
So I was listening to something the other day on the role of the Bank of International Settlements as a force amplifier for this concept of soft law. So in lieu of actual treaties between individual countries around the financial system, the global financial system, that's the role that the Bank of International Settlements played long before it actually started issuing anything that members needed to do. It was this, it played this convening role, right? And so the question is what is the institution on a Pan-African basis that can play this role? So, there is the African Union, the African Union Commission, and the various secretariats in that. But that like the EU, has a long list of things and competing interests between sovereign nations that it needs to manage, right? And again, as somebody with a British passport and a Canadian passport, I see the differences in confederation in Canada and European federalism, and how that plays out in the monetary space. And then the implications in the political space, and so the African Union has a similar challenge, and finding and supporting an institution that is going to, basically take some of the heavy lifting off that particular Pan-African institution, is going to be the solution to, accelerating the process and doing it in a way that scales across the continent, right? Regardless of whether it's a small country or a big country.
So every
That's
time
the gap.
I agree. Every time I do an episode with you, I mean, we are opening for part three because I mean, I really, we are about to eat the 60 minutes, so I'm not gonna get everyone to follow us now into a loop of institutional infrastructure. But that actually is a very interesting point. Actually, I signed myself on the side. There's something I wanted to touch with you was also, if you want, the monetary and currency convergence into one. So
Yeah,
maybe that's really an invitation for a part three, which is going to be
yeah,
maybe an institutional conversation
yeah,
together with a monetary conversation. And that
yeah,
one, I think, would exhaust in 3 episodes pretty
yeah,
much all the scenario and the element.
yeah,
So, but I think we have done a very good job this morning. I am much happier. I mean, last time we were very much on the up strategy, like a little
yeah,
bit on top of the sky. While today, I think we've been very, very focused in
yeah,
building a narrative that makes a lot of sense for everyone that
yeah.
is listening to us. So thanks again, Richard, for coming
Oh,
this morning.
thanks,
Appreciate your
Sergio.
time.
No, it was good as always, and look forward to the part three.
Likewise.
All
Have a
right,
great day. Talk
you too,
soon.
bud.
Thanks, Richard.
Cheers. Bye.
Bye.